when a strategist uses the term mean reversion, it tends to scare, especially when the markets are trading in or around new highs, if you will. And I think the note from Alpha Strategist, which is authored by Motilal Oswal Private Wealth, has used the term mean reversion. It leads me to question our two guests about what is their near-term outlook on risk assets across portfolios, which is fixed income, gold, and equity markets. Ashish, Shanker, and Nitin Shanbhag join me to talk about this. Gentlemen, thanks so much for joining in. I'm just asking you, what are you trying to imply when you use the term mean reversion?
Hi, Neeraj. Always a pleasure to speak to you and your viewers. Look, I know the word mean reversion, elicits a lot of things, but as the January edition lays the tone for the year for our clients as well as investors. So I'm just going to spend maybe a minute on the tone that we set at the beginning of the year and how that has kind of dovetailed into the theme for the month of March. Now, if you remember January, we had said that all asset classes look fully valued. And hence we said this is the year of the all-rounder, which means that investors are better off having allocation across asset classes, and there is no reason to go overweight or underweight on any asset classes because all asset classes look fully valued and all of them look reasonably attractive. Now, if you know, the last 3 years have been spectacular for equity markets, and within that, mid and small caps, especially in the last 1 year, have done extremely well. So much so that the valuations of the mid and small cap space have gone at a premium to the large cap space. Right now, whilst it may be justified due to earnings growth, but historically we've seen that mid and small caps are very cyclical and they end up eventually trading at a discount to larger cap counterparts. Right now, the reason for the term mean reversion in this particular edition is that we believe that valuations will somewhere readjust. Now, there are two ways valuation can readjust, Neeraj. One is the mid and small caps correct sharply, right? And as a result, they come closer to their large cap counterparts in terms of valuation, or the premium kind of narrows. The second way is the large cap counterparts do well and the mid and small caps take a breather. Okay, so we are no way implying that we are bearish on the market, but we do believe that a bit of both will occur. So which means that you will see some rotation into the larger cap companies because from pure valuation point of view, they're looking a bit attractive. The mid and small caps from a valuation point of view are looking relatively a bit more expensive. So possible that some of them might correct a bit and the larger cap counterparts may catch up. So that's the kind of rotation that we believe is likely to happen. Now, often it so happens that every correction comes with some narrative. And then when we look back, we say, oh, SEBI came down heavily on the small and mid cap part of the market, or now like we are seeing commodity prices move up and the inflation narrative beginning to ratchet up. So all these things eventually happen, and these narratives start building up. But at the core of it, I think is valuations. So that hence the word mean reversion.
The question though that I ask to both you, Ashish, and Nitin, is that the valuation differential has existed now at this alarming level too, if you will, for the last 6 to 9 months, right? So why now? Why this case for mean reversion now?
Yeah.
Okay, so
interesting.
If you look back over the last 4 years, and I'm just carrying forth the point on the earnings growth that Ashish mentioned, and we have covered a very interesting aspect of it in our Alpha Strategies edition as well. So if you go back to March 2020, which was the onset of the pandemic, and you now look at the end of earnings for December 23. So that's almost close to 4 years. The large cap earnings have compounded at 17%, okay, which is very, very significant. And obviously, we know that the last 3 years has been double-digit earnings growth consecutively. And this year, we'll have the fourth consecutive double-digit earnings growth. Surprisingly, though, if you look at the Nifty 500, that has compounded at an earnings growth of 32%, right? So it has significantly outperformed the large caps, and the Nifty 500 comprises all the mid cap as well as the small cap universe. Effectively, if you take the 450 stocks, so Nifty 500 minus the 50 large cap companies, 450 stocks in our Indian domestic context have compounded earnings at close to 70% in the last 4 years. That is very, very significant, right? And the market cap that has changed during this time period has actually not kept pace with this kind of earnings growth. So what we are saying is there are two elements out here, Neeraj, that one, the fact that stock prices are slaves to earnings growth comes to the fore from this, right? Second important point is that the kind of formidable earnings growth that we have seen in the last 4 years, we believe that for any expectation to have going forward, that the run rate will be the same is, I don't think, very prudent. And hence we believe that, given the sharpness of the rally that we have seen in the mid and small caps, there is a likelihood that these valuations, as Ashish also very rightly mentioned, are likely to correct in either of these ways, right? So either the mid and small cap prices will correct, or the large caps will outperform going forward. And hence today, our bias for incremental portfolio allocation happens to be large cap as well as multi-cap strategies, which any which ways tend to have a slightly large cap bias.
I'll just add a little color to it, Neeraj. See, in the last 3 to 4 years, and I know you're questioning the timing as to why now the mean reversion. See, if you look at the last 3 to 4 years, I mean, one of the things that has driven earnings growth is also base effect. Because prior to 2020, what had happened was you had the entire NBFC crisis, you had demonetization, and the mid and small cap space really struggled. They had balance sheet issues. Even from a sector point of view, there were multiple sectors exposed to the investment cycle which were not doing well. Now, over the last 3 4 years, you've had a lot of one-offs. Like in banks, you've had write-backs. You've seen massive balance sheet cleanup, and that resulting in earnings growth translating into high double digit. Even in mid and small cap companies, you've seen balance sheet cleanups, deleveraging, and many sectors which were not earlier participating in the profit growth in the economy have started participating. So multiple factors have come together and there has been a confluence. So every quarter we've been observing. Now the last quarter, if you look at December, it seems to us that from here on the earnings growth will be more normalized, which means that the kind of earnings growth that we've seen in the last 3 4 years and the re-rating that we've seen on some of these stocks may actually become a little more subdued.
Okay. Uh, so in some sense, are you saying that even if the actual numbers of earnings go up over a period of the next 24 months, the valuation multiple will be the slave to the pace of growth or the delta, and because that is slowing down, we might see a bit of a pull back in the multiples that the mid space is enjoying?
Absolutely, bang on. Because when you have rising earnings, that definitely leads to re-rating. But as the pace of earnings growth slows down, markets tend to become a little more sanguine about the multiples. So that's exactly, and we've seen a lot of re-rating happening. I mean, you look at the smaller NBFCs. I mean, even the government ones, where they were trading at 0.5 times price to book, they're now trading at 1.5 times price to book. You look at some of the cyclical sectors where the price to book was lower than 1. A lot of them are now above 1. So a lot of the re-rating, according to us, has happened. And from here on, earnings growth will dictate how the returns shape up.
Just the other aspect before, in keeping it macro, in some sense, because you guys talk to, service HNIs, talk to them, give them options, are people wanting to, and are you also telling people to, when they get out, or let's say partially book profits, or kind of correct their positioning into equities, and particularly the mid space, is the money being recommended to go back into equities alone, or is that money flowing into other options?
Yeah, so here for us, the first point is the investment charter, which we request all our investors to kind of adhere to, right? Because that inculcates a lot of discipline. So before trying to make any ad hoc decision, the first aspect is to revisit your asset allocation and be disciplined to it.
Sure.
And that also is true for any incremental money that you're doing.
Agreed.
So with response to your question on profit booking, etc., let's take an example. If you have an equity portfolio where a client has, let's say, 50% large cap and 50% to mid and small cap, and that's what is dictated in his investment charter, that he can adhere to this allocation, that he actually does not need to do too much. Of course, if his mid and small cap allocation has far exceeded his,
Nitin,
whatever he's put.
Nitin, sorry, I'm coming in, but my only problem is, I'm sure for individual people it'll be that way, but en masse, if I take an average, what is your advice been per se now? Are you telling people to get out of SMIDs because the valuation issues are there per se, and put that money into large caps or put that money into other asset classes? Broadly, as an average.
So Neeraj, the advice you're right is to go into the large cap or the flexi cap category from the SMIDs. But overall, we are not asking people to increase their equity allocation beyond their. I mean, we're not telling people to go overweight in equities. The advice remains the same, that you stick to your allocation, but you go marginally into more large and flexi cap kind of schemes.
But not move out of equities, I presume.
No, because on the whole, I think market valuations still look okay. Certain pockets look overvalued. But see, the other thing, Neeraj, is that, we've seen over the last 4-5 years, the cycles are very short. So whilst we are right now telling you that, look, the SMIDs look a little expensive compared to the large cap peers. Now, if let's say the market has a sharp correction, and we know in mid and small cap, the index corrects 10-15%, stocks can correct anywhere from 20 to 30%, right? So this entire narrative could get over very fast. So we are also watchful of that.
That's true. And viewers, that chart, and this chart will probably come up on your screen as well. The Nifty PE 1 year forward, the 10-year period average is about 20.3. As things stand post the corrective move that we've seen, we're probably at 19.5 or thereabouts as per this note. So in some sense, that validates the point that Ashish was just making. Okay, Ashish, Nitin, thank you for making that point. We'll just take a very quick break, and we'll come back and talk about some of the other aspects that are highlighted in the note. Maybe we'll try and talk about some of the specifics, outliers, what could go against this grain currently. Also try and talk about some of the other asset classes. Stay tuned.